As an accountant, we are required to keep tabs of all money that comes in and out of a business. In order to do this, we prepare and analyze different types of financial statements. There are three basic types of financial statements. They are balance sheets, income statements, and retained earnings statements. The first step in creating these financial statements is to create a proper heading. This heading contains 3 lines. Top is the company name, middle is the type of financial statement, and the bottom is the date. A balance sheet is the first statement that's prepared in this process. We prepare these statements every 12 months. These statements essentially tell us where our business is at financially and what our business is worth at this point in time. This statement is split into 3 sections. They are total assets, total liabilities, and total stockholders' equity that the company owns, sells, or buys. This is based on the accounting equation. Assets equal liabilities plus stockholders' equity. Because a company has 2 primary sources of funding, which are liabilities, which is our debt, and stockholders' equity, which is the money that we obtain from investors. When we add these 2 sources of funding together, it will equal our total investments, which is our total assets for that period of time. Moving on to income statements. This statement is created to keep track of all expenses and income we generate. We use this information to calculate our total net income and gross profit in a year. This statement is also split into 3 sections: total sales, total cost of goods sold, and total operating expenses. To calculate gross profit, we use the equation gross profit equals total cost of goods sold minus total sales. To calculate net income, we use the equation net income equals income minus expenses. Moving on to retained earnings statements. This statement is created to calculate our ending retained earnings for the time period using the net income that we calculated in the income statement. This statement contains the beginning balance of retained earnings, dividends, and net income. To calculate the ending retained earnings, we take the beginning retained earnings plus the net income minus dividends. Once we have made all these calculations, we use this information to create an annual report for our company. This annual report interprets our financial and investing status within our firm.